Welcome to the Big Mike Fund podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic. Starting now.
Welcome to the Big Mike Fund podcast. I'm the Big Mike
Zlatnik, and today it is my pleasure and a privilege to welcome back my honored guest. It's my pleasure and a privilege to welcome Neal Bawa. Hey, Neal.
Thanks for having me on the podcast, Mike. Great to be back.
Great to have you back. Neal is the CEO and founder of Grocapitus, if I'm pronouncing it correctly, as well as Multifamily University, multifamilyu.com. So that's the educational platform, and Grocapitus is the investment platform. If I'm forgetting something, please feel free to chime in. Neal is a frequent speaker at many industry conferences. He's well regarded, well loved. So it's so great to have you back on the podcast.
I'm thrilled to be back. We are living in interesting times. It's sort of the beginning of the year, so there's just a lot going through my head, and I'm happy to share thoughts.
Yeah, I would love to hear it. So let's start. We were recording this early part of the year in January, early January. So what's on your mind?
Well, obviously the first part of it is this interesting economy, right? So we love to bash the economy, but boy, this economy has bashed the crap out of everyone in real estate because it has stayed too strong. And you think about that and say, why is Neal saying the economy has stayed too strong? Well, I mean, third quarter, fourth quarter GDP were in the 3% range. And what's that allowed the Fed to do is, even though they cut interest rates, they're making it very clear that in the future, they're going to be cutting interest rates less. So the Fed, in their dot plot, which is basically their way of projecting rate cuts into the future, 6 months ago, they had 4 rate cuts for 2025. In December, when they cut the rate by a quarter point, they changed the dot plot. Now all of the Fed governors together show only 2 rate cuts next year, which means that a couple things have happened. And here's the good part of the news. The Fed would never cut the rate at which they were going to cut rates. Now they're slowing down. That's really what it means, from 4 to 2, unless they were absolutely 100% certain that we had passed beyond the point of a recession, right? So there's always this, the Fed is slowing down the economy, they're slowing down inflation, and the Fed has 9 times slowed down inflation successfully in US history, at least since the World War II, and only one time, the Fed succeeded in not having a recession when it was killing inflation. So the Fed has phenomenal tools to kill inflation, but its tools, unfortunately, are the kind that also tend to kill growth, right? So when you're killing inflation, you kill growth, and very often that means a recession or a shallow recession. So if you go back to World War II, the Fed's cut rate 9 times, 8 times out of that, the US economy went into a recession. And the 9th time, it was so close to a recession, Mike, that you might as well call it a recession, right? It just technically didn't happen. Growth was teeny tiny. It was just above zero. And so I think the Fed has a perfect track record of taking the economy into a recession when the Federal Reserve cut rates. This is unusual. And I think we can talk about why it's unusual. In my mind, it's simply because, in 2021 and 2022, we basically airdropped trillions of dollars of free money onto people, and those balance sheets are still there, especially for corporations. And secondly, we cut rates to zero, so many people have refinanced, companies, and individuals, that the impact of their rate cuts has been lower this time than it was in previous cycles where the impact was bigger. So we have this economy that basically is tricking us. It's not following instructions of the Fed. It's not slowing down. We've had inflation, which was nicely coming down. So it peaked at 9.1% in 2022, and then 8, 7, 6, 5, 4, 3, and now 3, 3, 3, 3, 3. It's just sitting there at roughly 3%. Whether it's there's 2 ways of measuring inflation. If you look at both of them, they're both in the low 3s. It's just sitting there. It's refusing to move, and the Fed's saying, you know what? If it's going to just sit there, I can't keep cutting rates because it might start going up, which is a horror scenario for the Fed. And so the Fed's saying, I think we've done enough. We did cut in December. We cut in September. Now we've cut 100 basis points. Okay, this is it. We're going to sit here and watch. And we don't know how long the Fed's going to sit here and watch. A lot of it depends on where the economy is going. But I'm just astonished at the extraordinary strength of the US economy especially when I compare it to Canada, the UK, France, Germany, Japan, China. With the exception of India, every other economy is taking it, you know, is doing really poorly, and the United States is just flying.
So I appreciate that great wisdom. It's a great observation of some of these recent events, and of course, things don't repeat exactly the way in the past. These are most definitely interesting times. I'll add just a couple of comments to your wisdom. First of all, I've had this discussion with a number of folks and a few observations. Last year was an election year, so we had an elevated level of government spending as a result of the election. So we continue to be still high on the COVID helicopter money plus election year. All that seems to be still rolling forward. The yield curve on inversion and sort of what's happening right now is still, in my view, a likely indicator of a recession. So we may still hit a recession. So this is just, again, we have future conversation, but not removing that possibility at all. But things that are doing really hot. No question about labor market still too strong. And I also go back in my head, every time you hear strong labor market, I think of the Phillips curve, that you can't really destroy inflation without higher unemployment. They're so joined at the hip. So we're dealing with a change in administration, which is obviously yet another uncertainty that Fed chair has to deal with. They just don't know how Trump policies will impact inflation from the tariffs perspective, sort of dodge, how much they're going to cut the government, where, when, a lot of uncertainty. All this is making maybe the markets a little bit nervous. Obviously, capital markets have stalled on the on the stocks and some of the other asset classes that have done really well. But you're also looking at our end of the world where we are commercial real estate. We need to see lower rates. I get Voxer messages. Voxer is a platform that I use quite a bit from another fund manager every day. 10-year yield is up. 10-year yield is up. And you know what's my answer? Stop freaking out. You got to give it a little bit of time. We might still see a slowdown just naturally with new administration. We just don't know. And when the rates are high, what do? You become a buyer, right? That's the good old rule. Because the rates are high, sellers and folks who need to refi, they are not in the best part of their business. So they just got to change the hat. You got to change the hat from, oh my God, when am I going to be able to sell, into accepting the reality I may not be able to sell soon. So what do? I have to put on a different hat, right? I'm just kind of changing this conversation to acknowledging everything you said, but thinking about how to respond to exactly that. Fact that the rates are stuck at a high level, they're going in the wrong direction. We're all frustrated about that, but there's nothing we can do about it. So what we can impact versus what we would like to impact is a different conversation. I would love to hear your thoughts on practically, given what's going on, what should people do? What actions do they take?
Well, I'm going to pick on something that you said and expand on it, right? So the fact that rates aren't going down as expected, especially because the 10-year treasuries actually started to tick up, right? And when you buy a occupied multifamily property, you're basically paying 10-year treasury plus a little bit over, we call it the spread, it's about 1.65%. So if the 10-year treasury is 4%, or the 5-year treasury is 4%, then you're probably going to put that 1.65 on top, and 5.65% is your rate. That's a very common description. So firstly, when the 10-year treasury is going up, it's putting pressure on sellers. So I had made a forecast about 5 or 6 months ago where I said, the window to buy multifamily at low prices could close by the end of this year. I'm taking my forecast back. I think that was wrong because of the continued strength in the economy, the continued strength in inflation, and potentially also the inflationary impact of what Trump might do. We can talk about whether he's actually going to do it or not. I think that the window stays open for 2025. I think that it would have closed in 2024 if rates were going to go down, because every time rates drop by a quarter basis point, we see a significant increase in activity on the multifamily side, where buyers come into the market saying, okay, we've hit the bottom, we've crossed the bottom. I was sitting, dry powder. I was sitting on the sidelines. I think that we've hit the bottom. We're starting to move in an upward direction, because institutionals, they don't try to time the bottom. They have too much money for that. What they want to make sure is that it doesn't go down after they enter, right? They don't mind that, okay, it got bottomed out and started going up, and now we started to put money in. That they're perfectly fine in. Their mindset is different from little guys like me that, have a $600 million portfolio. I'm talking about people that have a $6 billion or $60 billion portfolio. The way they think is they want the market to flatten before they enter. And what's happening now is they're not sure. They're not sure. They think that the market might actually scrape along the bottom for the next year. And so we might continue to get lower prices. Now, I'm very active on the buying side. I'm not having any luck with buying, but I'm very active. We are underwriting more properties than we have underwritten for years. We're making more offers than we have made for years. Finding inventory is tough because a lot of sellers who don't have to sell are saying, I'll just wait for another year. So inventory is a problem. And then once you get there, buyer seller expectations are a problem. I'll tell you something very funny. A lot of people think that if interest rates go up, sellers expectations and buyer expectations will come close together. This is a myth. It's a very common myth. People are like, well, in a good market, the buyers and sellers are far apart. Well, I have news for everybody. In a bad market, the buyers and sellers are just as far apart. Only the price goes down, right? So if the prices were here in 2022, this is where the sellers think the price is, this is where the buyers think it is, right? Today, all that's happened is the price has gone down 20%, 25%, depending on the market. But the gap between the buyers and sellers is the exact same, right? In 2008, when I was trying to buy $300,000 homes for $90,000, I was a net buyer. I was buying in cash. I thought that the price should be $190,000, and the sellers thought that the price should be $100,000. So even in 2008, with millions of homes on the market, there was a gap between buyers and sellers. That gap never goes away because the buyers and sellers are both unreasonable in their own way, right? So the point is, the first thing that investors should understand is that gap will never vanish. If you're waiting for that, you will never, ever buy real estate in your life. In a bad time, good time, doesn't matter, right? You have to just understand when you're getting a good deal and go for it. Today is a good deal. When I am looking, and there's reasons for that. I'm going to give you the specific reasons for why this is a very good window of time to purchase multifamily. Much better than a year ago, much better than 2 years ago, certainly much better than 2 years ago. Number one is, on average, you're going to pay between 20 and 25% less. And in some markets, you might even pay 30% less. So there's some markets that there's more pressure, but there's more product coming to market. The ones that had a lot of bridge loans. So Phoenix is a perfect example. Austin, there you might get a little more than 25% off. But generally, you'll get 20 to 25% off
the
peak. And the market peak was March 2022. So if you look at the peak, March 2022 peak to today, you'll get 20% off. You might get 25 on multifamily. On single family, that's not true. If you're buying a single family asset, you're probably paying a higher price today than March 2022 because there was a peak there, then it went down a little bit when the rates started to go up, and then it went up again. So single family prices in the United States on average are actually higher today by 6 to 12%, depending upon the market, compared to where they were in March 2022. So single family has actually gone the other direction, and it's, in my opinion, a really bad purchase because you're paying very inflated prices, right? And affordability for single family is at an all-time low. It wasn't even this low in 2007. It's a very, very bad affordability picture on the single family side. And the only reason the single family market has installed is because builders have been very aggressive with concessions. So they've done a very good job. They've kept prices high and they've given a lot of concessions. There's a lot of liquidity in the market, so you can get debt very easily. And most importantly, this massive growth in the stock market valuations, right? If you look at the stock market over the last 2 years, it's gone up trillions of dollars. That creates a wealth effect.
Yeah.
Right. So that wealth effect means that people are still continuing to buy homes, even though they're really pushing the limits in terms of what they should pay. But on the multifamily side, multifamily is a business, right? Buying a multifamily is really no different from buying a Taco Bell. You buy a Taco Bell based on its net operating income and a market cap rate. So today, what has happened is net operating income really hasn't changed much from 2022. Rents have gone up maybe a little bit, 1-2% in the last 2 years, not much. and expenses have gone up by that much. So NOI, or net operating income, the income of the property, has pretty much remained the same. If you look at 2022 now, not much difference. What's changed is cap rate. Cap rate is the multiple of net operating income that you paid, the multiple, right? So if you're paying a 5 cap, that's a 20x multiple of income. If you're paying a 4 cap, that's a 25x multiple. So the multiples have gone down, so you're paying less, right? If the multiples go from paying 4 cap to 5 cap, well, that's a 20% discount, and you're getting that discount today. So income hasn't changed. You're buying the same property with the same income, but you're getting a 20% lower price because of debt, right? That arbitrage is wonderful to have today. And it wouldn't be that wonderful because you'd be like, yeah, but my mortgage is higher. Yes, but there's something else that people are not considering, and it is an incredible wealth generator. It's a very, very important piece. For the last 2 years, we've had a phenomenal multifamily market and a really bad multifamily market. Both together, phenomenal and really bad, both together. In the last 2 years, multifamily has absorbed new incoming inventory, and that absorption rate has been the highest in history. Some of it has to do with the fact that we needed more apartments for all these illegal immigrants that are coming in, right, from the southern border. So obviously they need places to stay. But some of it had to do with the fact that the economy stayed much stronger than anybody projected, than the Fed projected, than you projected, me projected. Nobody projected the economy to stay this strong. So obviously the economy stays strong, there's more household creation. As a result, over the last 2 years, multifamily's performance has been off the charts when it comes to absorbing new units. What that means is the market is growing, everything that's coming in is absorbing, because we had the largest 2-year delivery of new apartment construction in US history in over 2 years. And all of it got absorbed. Now, statement is not quite right. Not all of it got absorbed, because if all of it got absorbed, if we were at 95% occupancy, we would have stayed at 95. We've dropped from 95 to 94, right? So nationwide occupancy was a little over 95. It's a little under 94 now. So there was a little bit of a gap there between, supply and demand, right? But overall, the industry people that have been looking at this for 30 years, their jaws are hanging down, Mike. How did we absorb 1 million units in 2 years? That is a stunningly good news for multifamily. And then on the bad side, we haven't been able to raise any rents. Why? Because 1 million new units are coming in, and all of them are 2 months off. So every developer, including me, I currently have 600 units leasing up. Everything is 2 months off. Everything that I'm leasing up is 2 months off. 2 months for free, pay 10 months of rent, right? So as a developer, I'm using that mechanism as a way to compete with existing cheaper properties, the Class Bs and the Class Cs, and so they're not able to raise the rents. So we have this bizarre phenomenon of extraordinarily high performance when it comes to absorption and demand, and terrible performance when it comes to rents. And it's terrible. Rents haven't gone down, they haven't gone up, they're flat. So you might say that doesn't seem too terrible. No, look, last 50 years, rents always go up, right? Rents are like clockwork. If inflation is 2%, rents go up 3. Inflation is 3%, rents go up 4. Just look at 50-year charts tracking rents and inflation. You notice rents either track inflation or stay above it. So some years they're above inflation, some years they're at inflation. They're never below inflation. But we've had a lot of inflation in the last year.
What's the wisdom on a forward outlook and I think I heard you speak on this, is that 26 is supposed to be a phenomenal year. 25 is a year of sort of buying while you can. And then 26, you run out of new supply completely and your rents start going up. So your NOI is growing. And even we can't control the interest rates, but at least from we
can control rents.
Yes.
Right? We can control rents. So I think the focus of the industry has changed from what they cannot control, which is interest rates. I don't know what's going to happen to them. Nobody else does, right? To what we can control. And we have not had rent control over our rents for 2 straight years. We didn't have control in 2023, 2 months supply. We didn't have control in 2024, 2 months supply. But in 2025, at some point during the year, every market in the United States, except maybe 2 or 3, right? There's about 323 markets in the US that we track. Maybe half a dozen will be separated out, but every other market at some point in 2025, that supply is gone. It's finished. In 2026, we delivered 660,000. 2024, this year, the year that just finished, we delivered 660,000 units. We're now delivering 325. And I'm telling you, the demand is way above 325. So if we deliver 325, in 2025, we get pricing power back. We get the ability to raise our rents. So the latest forecasts from last week are 3 to 4% rent increase, which is great. Not awesome because inflation's at 3. So if you look at the last 50 years, usually you would get 1% more than inflation. That's 4. So we get 3 to 4%. So it's still an in-between year. And rents are not going to rise enough for values to rise. So you can still lock in low prices. But 2026, at this point, we're only on track to deliver 230,000 units. And here's the coolest thing. The Fed can change its mind and raise rates. Trump can do something destructive and tank the economy or grow it so fast that inflation goes up. I have no control over any of that. But I do have control over one thing. I know exactly how many units are going to get delivered. Not exactly, but I know pretty much how many units are going to get delivered in 2026. Why? Because I can just count the construction permits in 2024. It takes 2 years to build a building. Nobody has figured out how to build multifamily in a year. I haven't, nobody else has. It takes 2 years to build. So if you didn't pull a permit in the last quarter, you're not going to deliver it in the last quarter of 2026, right? So there's no way to increase the number of multifamilies that we are going to deliver in 2026 now. If it was going to increase, it would have happened in 2024. We're already in 2025. So we know that there is a shortage of multifamily in 2026. And we will see a spike, a very significant spike in rents because we have pent-up demand. Our insurance costs have gone up. Our payroll cost has gone up. We're sitting here absorbing all of that because we don't have pricing power, because we're still waiting for this inventory to come in. But the moment that happens, I promise you, every landlord in America will raise rents because we haven't raised them for 2 years. And you're going to see a wave of that in 2025, not every market. And then in 2026, every single market in the United States. I think I would be shocked if we don't get 5-6% rent increases. And sometimes your investors, Mike, don't understand. 5-6% sounds like a very small amount of money. Guys, if you raise rents by 20%, we double your money, right? So when you get 6% in a year, we're dancing naked on the street with champagne bottles, right? That's 3 years of rent growth.
Yeah, and I love it, Neal. You are what's it, Mad Data Scientist of Multifamily. You got this pad down, and I'm very honored to have you speak on this. The wisdom is data speaks, math speaks, and the math points towards very likely significant rent growth in 26. So the time to buy is now. The prices are substantially depressed off the peak. And even without the direction of interest rates, just the rent growth factor is a significant driver of future NOI growth.
And so is the cap rate. Remember, Mike, there's one factor that we haven't talked about. There's 3 real things that drive things, right? So one is interest rates, the other one's rents, but there's this third thing called cap rates. And cap rates are actually an emotional thing, right? So I'm going to talk about those, but I also believe that we're going to see cap rate compression in the coming 2 years. I don't know when, but at some point we'll see that. That's the third widget that basically changes profitability for us. And it's in our favor now. For the last 2 years, cap rates have been against the industry. For the next 2 years, they're going to be with the industry. So we've had headwinds, and now that's turning into tailwinds.
Yeah, I appreciate that. I mean, I guess cap rate is connected to the level of the interest rates. That's always been sort of there is a relationship.
Yeah, that's where I disagree.
It's that emotional.
Yeah. But what I can tell you that cap rates are not always tied to interest rates, and I'll tell you why. Right? If you think about it, cap rates in the United States have been dropping for about 10 years until 2023 when they started
low
to go
interest
up,
rates, right? They've been dropping
yes.
in relation to the low interest rates. And
yes and no. If you look at the 10-year chart, you'll notice that there were times during that time when the Federal Reserve, started to raise interest rates. Remember, they raised interest rates before COVID, and then they stopped and they went backwards, right? So they went up, then they went down. Cap rates continue to drop. So cap rates are a factor of interest rate for sure. When you have interest rates that are lower, you're going to have cap rates that are lower. No argument in that. But Mike, they're also a factor of how rich people who buy real estate feel about real estate. When people feel that the next 2 to 3 years are going to be better, they pay lower cap rates. When people feel that the next 2 or 3 years are going to be hard, they pay higher cap rates. So there is an emotional component to cap rate, and you must not underestimate it. Yes, interest rates are a big component, and we have no control. But emotionally, this industry has been hit very hard in the last 2 years, and so everybody wanted to pay less. I am not hearing that now. I'm presenting at conferences, and people are like, we're going out to put more money in. Look at BlackRock. I mean, look at what the big guys are doing, right? Was it BlackRock or Blackstone that just bought a $2 billion portfolio? That kind of money hasn't come in for 2 years. They're saying, okay, you know what? We enough drop in prices. It's time for us to enter. Big deals are being done by big guys, and they're the ones that drive price, not us. I'm too small. You're too small. But the guy that writes a $2 billion a year check, they move markets, and their belief, their thoughts affect cap rates just like interest rates do.
Yeah, I think it's a great wisdom, and I will add this comment. Most of those guys are really not emotional. So what you are stating is
Yes.
the
Yes.
state of the market, the general perception, but really they're driven by the data that you just described. So that data
Yes,
is telling them the same thing.
BlackRock and Blackstone has 60 guys sitting in a room saying, you know what, the next 2 years are looking good.
So it's a forward PE growth. It's a forward projection of the growth driven
Of
by
the
the
NOI.
high rents. Therefore, we can pay lower cap rates because the NOI will grow, and that'll compensate for the cap rates being a little bit lower than.
Yes.
And again, they're buying them at sort of pretty discounted cap rates versus a couple of years ago versus the peak. So from that perspective, all these theories.
They've got a little bit of room.
Yeah. And the I'm not surprised, but everything you said is what I've seen and observed, that these deals we're not seeing massive distress by any means in the industry. You have a few distressed owners with the messed up capital stack, liquidity issues, but in general, the industry is not necessarily distressed at all. But at the same time, you're not finding a lot of great deals as a result of lack of real distress. So finding a great deal is hard, but when you find it, and I'll tell you this, we have a great deal coming up, and almost fell off the chair when this deal was brought to us with the cap rates. Basically, when I'll tell you these numbers, they look staggering. It's almost like hard to believe how good of a deal it can get. So the deal that we are working on right now, it's a multifamily, large multifamily, over 1,000 doors in Midwest, with the going in cap rate in the high 8s to low 9s, depending on how you look at this. You look at this stuff, it's like, how is it even possible? So deals like this, when they come across, they feel absolutely phenomenal deals because it's such a ridiculously good price. And I go back to what you said. There's a spread between the 10-year Treasury yield and then the cap rates. And I think you referred to the mortgage rate spread, but there's also cap rate spread.
Sure.
And to me, it's 180 basis points. It's a little bit higher than the
165 that I mentioned. Yeah.
So you're talking about Fannie Freddie mortgage spread versus the.
That's
so
right.
What's really interesting is that using even the current interest rates, the cap rates are around 6.5%. You take the 10-year Treasury at 4.7, you had 180 basis points, it's 6.5 more or less.
Right.
So any deals you could pick up above that theoretically is you're already ahead.
Definitely ahead. And again, you're ahead not factoring in future PE growth, right? So you're already ahead just purely on the cap rate basis if you can get to that 6.5. And that's really the trick. How do you get these deals? I wanted to address what you said about distress, though. There's a lot of complete and utter nonsense being written in the real estate press about distress or upcoming distress. I think this is a absolute bullshit idea. There is distress in multifamily. Individual projects are distressed because they're losing money. There are projects that are going to be sold at a loss, so investors will lose money. That is not the same as market distress. Multifamily is a very large market. There are over 20 million units being tracked by Yardi Matrix and CoStar. Of those 20 million units, only about 4 to 5% have loans that have to reset in the coming 12 to 18 months, right? Very, very small percentage. In fact, the largest portion of the multifamily market has fixed debt. So This is what most people don't, they're just focused on this tiny little piece and they somehow attach it to the whole market. No, a very tiny portion of the market has distress. Individual syndicators are distressed. Their investors are distressed. This has no connection to the market. Today, when we go in and make a best and final offer, 2.5 years after interest rates started rising, Mike, when we go in and make a best and final, there are 15 offers on the property. 5 of them are 100,000, 200,000 hard money day one, sight unseen, without even doing due diligence of 30 days.
But what
They're
is the
putting
price
down
today
money.
versus the price a couple of years ago? I think what the
Lower price, for
misconception
sure,
is,
right? Better pricing. But what I'm saying is prices have dropped, interest has not. Maybe there were 30 offers on it, so maybe it's dropped a little bit, but there's still 20 offers. There's people fighting over multifamily properties at cheaper prices. That is not the definition of distress. That is actually the distress definition of a seller's market. Today, multifamily is a seller's market at a 20% discount. But sellers have
I'll
so
add
many choices.
This comment. So you're absolutely right on the front. I've heard you speak exactly that point, and I agree with you. In general, the overall market is not in distress. But I just want to comment on a couple of quick things. Number one, people who wrote a check in 21, 22 at the peak of the market, plus minus, their equity position in these deals feels severely distressed because the assets are worth less. If they can walk away with their original capital, they would be ecstatic. So essentially, it's now a battle for them to get their money back in a couple more years with market recovery, right? So that's what it feels like. Worse, if these deals have to be liquidated today or simply run out of cash, then they lose the entire investment. That's what the feeling is, right? That we both know that. Another interesting point, which you just brought up, only a small percentage of the deals need to refinance today, but that continues to roll. And I'll tell you this, I refinanced one property in New York City, 70 apartments in 2018 or 19. I'm just going by memory. And I had an option of 5-year fixed, a 10-year fixed. They took 10-year fixed, right? And that's a saving grace. I am good, in really good shape. But I go back and I think 5 years would have passed, and now I have to refinance the property. Trouble, because the rate on that mortgage is I'm just going by memory, 4.3%, right? Now it'd be approaching 7, right? That's the problem. Now you have to refinance. If you look from the owner's perspective, it's very, very painful because you can't meet the debt service coverage ratio, and you're suddenly in a precarious position that you got to raise some equity. You got to pay down the mortgage. You got to deal with the fact that you can't afford debt service. So it's one of these difficult conversations where the industry is not distressed in general, but the experience of number of investors, equity investors who's written checks is not fun. This experience is difficult. And then if you got to go refinance, perfectly good asset, it's painful to do.
Well, can I say something that is going to sound horrible and heartless, but maybe also true, right? There are roughly 3,000 distressed properties and a total of 5,000 that are not distributing. Okay. As I'm assuming each property has 200 units. So 5,000 properties that we're talking about. If each property has 40 investors, we're talking about a maximum of 200,000 investors. Now, many of those investors have invested in multiple properties. So we're not really talking about 200,000 people, but let's just assume every investor only invested one. There's 200,000 unhappy investors and maybe 5,000 unhappy syndicators, probably less. The total number of accredited investors in the United States is somewhere between 11 and 14 million. The total number of people that invest in real estate is in the millions, right? So what you're talking about is the market that I see and you see, Mike. You talk to your investors, I talk to mine. We are inside a bubble of the tiny, tiny portion of the accredited market in the United States. Out of 14 million, we're talking about 200,000 people. They're unhappy, right? But the market is driven by the rest.
Agreed. But we have the experience dealing with existing projects, with existing investors and their concerns. And it feels way worse than it really is. And then at the end of the day,
because of our bubble, right? That's our bubble.
Yeah, and then the new deals, that's the bottom line. I think we both have exactly the same sort of a vision. We got to go find new money who has not been impacted by some of these recency bias, so these difficult equity positions on these deals. And this ton of capital, just the amount of capital created because of the stock market appreciation, crypto appreciation, gold, precious metals, is humongous. And the opportunity to go after these new dollars is absolutely great opportunity. So from a deal perspective, we started this whole conversation. You started with an update. I said the mindset. It's the time of opportunity. Great new deals at a historically high cap rate. Well, not historically high, on a relative basis. On a
relative basis, yeah, last 20 years. Yep.
You just got to go find investors who are not hurt, tortured, in a difficult state of mind from a recency bias. You remove that, suddenly this looks an incredibly attractive opportunity to participate. So with that, it's an abundance and opportunity mindset versus when do we get out of the old deals? Well, I don't know. Maybe it may be a couple more years, and we do know that 26 will be a better year. We do know that, but we got to get.
I think if deals can survive until 2026, out of those 5,000, some portion will be able to sell and break even. Some portion will be able to refinance, and some portion will be able to refinance at 5 years with a small equity injection. The rest will have to be sold in 2025 and 2026. But if I calculate that 50% of them don't make it, that's 2,500 properties across a very large country. When I look at an injection of 2,500 properties across the next 18 months, it doesn't scare me at all. That is not a glut. That is not a flood. That is simply some loosening in the marketplace and some extra opportunity for me as a buyer. I'm looking forward to that. But if it was 10 or 20,000 properties, I would be very worried.
So the conclusion is what? Is cautiously very optimistic about the future, taking action today. Don't worry about recency bias, or at least try to put it aside. And
you have to put it aside because it's first in our heads, then in our investors' heads, right? I think that we're as much of the problem as the investors are. And I've been able to convince my investors who are in those deals to invest in my new deals, because I'm telling them, so you invested in my deal and you bought this property at, with me at $25 million in 2022, and you didn't have a good time. Interest rates changed for you. Now I'm buying this property at 19 million. Same property, same NOI, right? Put aside what has happened in the last 2 years and answer this one question. Is this by itself a good deal? Is it a better deal than you were willing to give me $1 million for in 2022? Yes or no? And every time I ask the question in that way, the answer is yes.
Yeah, it comes down to faith. Can you still do well with new money on new deals? And some folks have been concerned. It does this back again, recency bias, but I concur. The wisdom, the start of 2025 is mindset, positivity, time of opportunity. Even though you're saying it's a seller's market, I still think it's a buyer's market because the cap rates are low. So if you're not looking for perfection,
it's a seller's market when they can sell to a dozen people.
Absolute bottom of the market. We are somewhere in that. We're trading. We just don't know if recovery will start in Q1, Q2, but we are somewhere already at a point where the correction has already taken place and the opportunity ahead should be meaningfully better.
I think we have a good way to see the numbers. And here's what I'll say. The United States is broken into 3 or 4 major chunks, right? So you've got the West, you've got the Southeast, which is where a lot of the syndicator money went in. Then you've got the Northeast and the Midwest. I invite anybody to look at rent growth in the last 6 months in the Northeast and the Midwest. Why those 2 areas? They didn't have supply. They didn't have massive new areas.
We're seeing that.
And you look at the rent growth there. That rent growth is already there. Healthy. And the Southeast and the West will join that rent growth in 12 to 18 months when their supply ends, right? So the Midwest and the Northeast are offering you a view of the future.
Yeah, I concur with you. I've had this discussion quite a bit about in the Midwest where we do a lot of investing, and that's exactly the product. There's no new product. This oversupply problem of Sunbelt, they don't exist in the Midwest. All the money went to build the Sunbelt, and that's why it got overbuilt, and that's why it's dealing with a high absorption. But demographically, a lot of people moved in those states. Texas, Florida, etc. Phoenix because of retirement, because better tax environment, etc. nonetheless, affordability is still pretty strong in Midwest.
The Midwest is doing well now because I think Phoenix and Houston and all these places that used to be cheap 15 years ago, they're expensive now. They've gone in a single 15-year time frame. Phoenix has gone from being a cheap city to an expensive city, right? And that's happened across the board in the Southwest. So a lot of the migration that was happening for price reasons has slowed down from the Midwest. It's slowed down from the Northeast. People are saying, why the heck would I want to go there? I mean, I went there, I flew there, I looked at the price of homes, it's crazy. I looked at the price of rents, it's crazy, right? I'm just going to stay put. People weren't doing that 10 years ago because if you moved to Phoenix 10 or 15 years ago, you got a huge discount, right? Your quality of life went up. And that isn't happening anymore. And so I think that the Midwest actually has a much more powerful story to tell today than it did 10 or 15 years ago, because from a price comparative basis, the Southeast is not cheaper.
Yeah, I'll add one more element, and I think all good things must come to an end, so does this episode. But the one thing that I wanted to add is weather patterns have been changing. So people used to move south because north was too cold. And I'm in New York, it's cold, but today is especially cold day. But overall, it's gotten more mild. This is interesting. Same thing in Midwest. It used to be terrible, super heavy snow winters, and it's not as bad. So the experience of living in those towns and cities is not as bad from that perspective. So the weather, the changing weather patterns making sort of a Midwest, maybe Northeast, a little more tolerant so interesting. Appreciate your wisdom. It was a great conversation, great wisdom, great sharing. I share your enthusiasm and your cautiously optimistic tone, and obviously the mindset. And the time will show. And for those folks, I'll add one more and would love to hear your final sort of thoughts and comments. We don't know if recession is going to come, and something that we would welcome. We almost need some kind of correction recession. It's almost not good, not healthy for the U.S. capitalist society not to have some kind of correction. So nobody wants to see unemployment and people being hungry, but we're not talking about any of that. We're talking about maybe some level of adjustment.
Shallow recession.
Shallow recession. I think it'd be absolutely welcome, and it's probably, given what's been happening with the yield curve and inversion and uninversion, everything else, I still feel that we might see something later part of this year, especially if Trump actually does what he says and they start cutting the government, which may be something that we're long overdue. The size of the government relative to the size of the economy is kind of out of control.
Yeah, I believe that the Federal Reserve trying to prevent recessions is problematic. I think that they should change their mandate to making recessions shallow. I think recessions are part of the business cycle and part of the money cycle, and we are trying to eliminate them. I understand why the Fed does it. There's a lot of pain associated that, millions of jobs get lost. But I wish that they would change their mandate to accepting shallow recessions.
Appreciate that wisdom. And another thing that Fed probably needs to change, people have talked about this, their target 2 to 3% inflation may be unrealistic. Maybe the inflation needs to be reset to 3 to 4%, and then maybe the life for the next 10 years, who knows? Especially in light of the Fed, well, not the Fed, the government spending far above its means, and the budget deficits continue to grow, the amount of treasuries that need to be sold, and that will continue to put inflationary pressures.
Here's the good news on that one. The Fed doesn't control the, inflation rate. The inflation will do whatever the heck it wants to do. It doesn't care about the Fed. The Fed doesn't mean anything to inflation. The Fed will have to change its tune when inflation does what it does. So the truth is, inflation is its own creature. The Fed can only influence it slightly in this direction or that, but cannot change the overall trend. We are trending towards higher inflation, and there is nothing that the Federal Reserve can do to prevent it.
Other than reset their policy and reset their normal.
They will adjust. The Fed is actually, thankfully, the only data-driven quasi-government organization that I know that I respect. The rest of them are just shills, but the Fed actually looks at the data. I think they will adjust. The only thing is I find the Fed slow, like any other government organization. They move slowly, they change slowly, but at least they're data-driven. They'll see the writing on the wall. I think that 2% inflation number is going to become a 3 to 4% range over the next 5 years.
And hopefully it's a great news for real estate, because real estate is a hedge against inflation. As long as rents keep going up, let it be 3%, let it be 4%. So
exactly, we don't care. We actually like slightly higher inflation. We don't like high inflation. We like higher inflation.
agreed. Thank you, Neal, for your wisdom. Thank you for coming on a podcast. Happy and healthy and prosperous 2025. Always great to talk with you. And enjoy the winter and hopefully great year.
Sounds good. Hopefully, I'll get to see you at an
How would
upcoming
folks reach
conference.
out before we?
So very straightforward. We invite about 14,000 people a year roughly to our webinars. We hold webinars on all of these topics. Like there's a dozen of them, some about Trump, some about the economy, some about real estate, some about other things like AI. And they're all at Multifamily University. So just go to Google, type in Multifamily University, join our community. It's free. There's no paid education. It's free for everyone. 1% of the people that are in that community become investors with us. The other 99 enjoy free education forever. That's the best way. Multifamily University.
Thank you, Neal. Appreciate your sharing and appreciate you providing service to the community. Education is a very important element of the whole ecosystem, and usually a free education. Be careful what you pay for, and if you get free education, it's dangerous. But I've seen your stuff. Your free education is high quality, great stuff. So thank you for doing the service.
Thanks so much, Mike. Have a good one.
You too.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.